and welcome. We really appreciate you signing on for this topic of insurance. My name is Mark Buckhalter. I'm a member of the Community Association Resource Group. We also affectionately call it CARG, C-A-R-G. CARG's a consortium of various disciplines that we vetted before they were able to become members of CARG. So we feel very comfortable in referring each other. Some of the members that we have on CARG, obviously, I'm going to start with myself, selfishly. I do monthly accounting. We have Terry Russo with Central State or South State now for banking. We have a cable consultant. We have fire, water, and mold remediation, which is SoPro, Adam is on. We have janitorial services and light maintenance. We have landscaping. Charles is on from GRC Landscaping. We have paving and seal coating. We have a contractor for pool services. We have Catherine on for public adjusting. We have also a roofer, Paul Baines Roofing. We have a new member that does basically turnout pest control. That's forever gone. And last but not least, we have Jeff from Support Depot, who does a lot of marketing for many management companies, associations, and web support. Today's topic basically is probably one of the most important line items of
Mark, I'm going to interrupt. I'm getting a few questions that it's difficult to hear you. Can you turn up your voice volume a little bit? Speak up a little louder.
All right. Thank you for that, Jeff. Anyway, today's topic with Brandon Levy from Legacy Insurance is probably one of the most important line items that I go through as an accountant every single budget. It takes up probably your most expensive item on the budget. And most communities, unfortunately, do not give enough time and ask for advice before the budget from their insurance broker. Brandon's really been a valuable source to me with my clients when I go ahead and do the budgets. He's probably about the first person I called, or I have a client call him to say, what's our insurance anticipated? And again, Brandon, I know you'll be going over it, but it's always a guesstimate. And some insurance brokers play a game to try to retain you. Brandon's just not like that. He has a wealth of knowledge, nice guy to deal with. So with that said, I'm going to go right into the presentation with Brandon. And after the presentation is over, if anyone wants to stay and ask any questions of any of the other members of CARG, obviously there's no obligation. It's just basically free good advice. So with that, Brandon, I'm going to turn that over to you. And okay. And again, thank you everyone for joining.
Okay, thanks, Mark. Thanks, everybody. I appreciate it. Jeff, I don't know if you're going to put up the first slide, but just here we go. Yeah. So anyways, first of all, I just want to say thank you for everybody that's joining today's meeting. I know we sent this out to a lot of property managers, a lot of board members for condos and HOAs, a lot of my current clients. So really appreciate you guys coming in here to listen to this presentation. What we're going to basically go over today is a bunch of different things. About understanding your insurance program and strategies that we're using and really need to be used to help reduce any rate increases. If we go to the next slide, just quickly a little bit about me and my agency. Obviously, my name is Brandon Levy. I am the owner of Legacy Insurance Associates. My agency has been open since 2015. We insure over 500 associations now, which we're really proud of. I've been in the industry for 20 years. I have a CPIA designation, which is a certified professional insurance agent. And if anybody needs to contact me, my office number is there, my cell phone number, and my email address. So, I want this presentation to be fun because insurance can be a little bit boring. So I want to be interactive as much as we can. But if you're shy or you don't want to talk over this, please contact me after, and I'll be more than happy to answer any questions you guys have. Okay, so with that being said, let me go over everything that we're actually going to go over, excuse me, which is on the table of contents. So first and foremost, I'm going to go over understanding how your insurance program works. And we're going to put a slide on here of a sample proposal so that we can go over all the different lines of coverage. From my experience, knowing that insurance is so expensive, I see that a lot of agents don't take the time to actually explain in an easy way how the policies work. And I also believe that it's a little bit easier to justify the cost of the insurance when you actually understand what you're buying and how it works. So that's going to be the first part of the presentation.
And Brandon, I'm going to interject really quick because there are going to be questions coming up. All of the slides, for those of you that came in late, everything you see today on the screen during the course of the presentation was as a link available for you to download in the reminder email that came in an hour before the event. And we'll also make sure it goes out to you in the follow-up email. So we'll have the slides available to you afterwards as well. Sorry for the interruption. Back to you.
Okay, no worries. Then after we go over that, answer questions, I'm going to go over the main reasons why premiums are actually going up. A lot of agents just say premiums are going up 30, 40%, deal with it. I want everyone to understand why it's happening because there's a lot of different determining factors. Then I'm going to go over some strategies that I've been using with my associations on how to help minimize the rate increases. That's an extremely important part of this program, and making sure that you're doing everything that you can to continue to keep your cost as low as possible. I'm going to talk about, some risk transfers and how, having a risk management plan with your association is a benefit to keeping your rates as low as possible. And then we're going to go over a few other things, such as how your HO6 policy, if you're a condominium association, how those work in conjunction with the master policy, because that's a very important part of your overall insurance program, both for the unit owners and the board and the association. And then finally, I'm just going to briefly go over how, and this is more for really property managers, really how to read and understand a certificate of insurance, what needs to be on there and why it's important for the association. Okay. So that being said, the main topics that we're going to go over underneath the proposal are going to be property, and how the different programs work, because there's a bunch of different programs in property, general liability, and how fraud is making premiums increase. We're going to go over crime and how to determine your crime limit, how the directors and officers policy works and who it protects, how the umbrella coverage works and why there's such limited carriers in the market, the changes in the flood programs that have just changed October 1st, a new product that's been out there a couple of years now, legal defense, how that works and why I think it's an important product, and then quickly about cyber insurance. So I know that's a lot. I'm going to try to get through it as fast as we can, but hopefully at the end of this, you guys will learn something. So Jeff, if you could go to the other slide, the sample proposal. Okay, so this is a sample proposal of what you would normally get from my agency and what I would assume most agents are presenting. This is a sample proposal. So obviously the first page of the proposal normally shows what the name of the association is. Now on the second page, this is the property insurance. Okay, so this is the most expensive portion of your insurance program. Okay, this is covering your buildings for perils like fire, lightning, windstorm, hail, vandalism, hurricane. And this is the part of the insurance program that's going up dramatically. So let's make sure everyone understands how it works. Okay, so in this specific example, we're talking about American Coastal, which they're one of the largest writers of condos and HOAs in South Florida. So when you have this in front of you from your agent, let's make sure you understand it. So on the right-hand side, you're going to see the limit 11,481,000. That's your building limit. That valuation when you're a condo and for an HOA, you really need to, that limit needs to be determined per an appraisal that's done every 36 months. That's the state statute. So the state statute basically says, hey, listen, you have to get a new appraisal so that we know what the value of the building is. So if there's a loss, we know what it costs to replace the building. Okay. A lot of associations, not a lot, but some associations say, well, listen, if we get a new appraisal, you know, the value of our building is going to go up. Yes, that's true. But if you don't get a new appraisal and you're underinsured your building, then you're going to have even bigger problems on your hands. So it's very important that you have that appraisal done every 3 years. In this example, you know, there's other things that obviously you need to insure inside of a condominium or an HOA, contents, if you have a swimming pool, the pool equipment, carports, you know, basically all of the things that are on your appraisal are what needs to be on your proposal. Now, with some carriers won't cover all of your property. In this example, American Coastal will not insure aluminum fencing or masonry walls. So there are other insurance programs that are out there that are called layered programs. Layered programs are instead of one insurance company like American Coastal taking on the full $11 million of value, layered programs come in and they say, okay, we'll take on the first $5 million of value. And then another insurance company comes in and they take on the next $2.5 million and then the next $2 million. And by doing that, they spread out the risk to multiple insurance companies. Those tend to be cheaper with some types of programs, not in all programs. But on layered programs, they are able to almost always insure all of the property that you need on an appraisal. So it's really important that your insurance agent is marketing the account properly to make sure that you're getting everything covered and going with either layered programs or with carriers that do the entire risk. Now, with respect to how the deductibles work for condos and HOAs, and specifically for hurricanes, right now in this example, if you look in the middle, it says hurricane deductible per calendar year, 3%. What does that mean? That means that in the event of a hurricane, your deductible is 3% of what we're insuring for. So in this example, 3% of $11 million. Some board members, some property managers think it's 3% of the claim, which is not the case. It's always the percentage of what you're insuring for. Okay. So in this example, 3% of $11 million is going to be over $330,000 in a deductible. And in this example, it's for a hurricane for the entire calendar year. Now, there are in layered programs, there's different types of deductibles. You can get deductibles where your deductible is a percentage of the building, but for named storms. So if a storm has a name like a hurricane, like a tropical storm, then your deductible is 3 or 5% for any named storm. Obviously, if you do it that way, then your premium is going to be less because you are taking on more risk for any storm that has a name, as opposed to your deductible being a percentage just for a hurricane. So in a market where rates are going up, and I'm going to go over why rates are going up, but in a market where rates are going up tremendously, you have to make sure that you're looking at all the different deductible options on property, both hurricane deductibles for calendar year and named storm deductibles. Okay. Before I go on, because that's an important part of the presentation in terms of understanding it, does anybody have any specific questions about how those work, or am I clearly explaining that? Do you see any questions right now, Jeff, or anybody?
We have a hand. We have a hand up. Do you want to allow the person to ask the question now, or do it at the end?
Yeah. Let's do it.
Victor. Victor, it says you're using an older version of Zoom, so I cannot enable your mic. So type in your question, please, Victor. It won't let me call on you because of your version of Zoom. So type in your question, Victor.
While we're waiting for him to type in the question, the other parts of this coverage that are really important is where it says ordinance or law. Ordinance and law is giving the association coverage for 3 different things, which is coverage A, B, and C. Coverage A is for the undamaged portion of your building. Coverage B is for demolition and debris removal. And coverage C is for increased cost of construction due to new building code. So let me just give you a very quick example so you can actually understand what that means. Let's say
there are questions in the queue when you're ready. Okay, Mark and Brandon?
Yes,
Okay.
Got it.
Okay, go ahead.
But just quickly about ordinance and law. So let's say the building is worth $10 million and we had a claim. Let's say there was a fire to the building and half the building is burnt. That would mean that we had a $5 million claim. So the insurance company would give you a check for $5 million and then they walk away. They don't give you a new building. But you can't rebuild a new building on a half damaged building, right? Because you need $10 million. So coverage A, for the undamaged portion of the building, they're going to pay you the other $5 million that you need to get you to the $10 million. Then you have to knock down the building and remove the debris, which is what happened at Surfside, if everyone recalls. So coverage B is demolition and debris removal. So you definitely need to have that coverage. And then coverage C, now you have to rebuild the building up to new building code because 2020 code is what you have to rebuild to. So you have to make sure that you have the proper ordinance and law limits on your policy so that you don't have an issue where there's a claim and you can't get the money you need from the insurance company. Go ahead.
Brandon, because I always speak to our clients talking about the law and ordinance coverage. And I give them the example as far as like with windows, as far as bringing it up to code. A lot of these windows, might be 30, 40 years old and the insurance company is only going to pay. And that's really the analogy that I try to give them, why it's so important to have a law and ordinance coverage. Maybe you can cover that.
No, I mean, it's a really good point. I mean, if you think about it, if we had a hurricane or a tropical storm and it comes through and damages our buildings, most of the buildings that are in South Florida don't have high impact glass windows. So if you had to, of course, the insurance is only for replacement cost. So they're only going to give you the coverage that you need to replace the old window. But when you go out to try to replace the window, the county doesn't allow you to replace it with the old window. You have to replace it with the new high impact glass windows. So coverage C of ordinance and law gives you the coverage to rebuild up to new building code. So again, it's very, very important that you go over the different ordinance and law limits to make sure that you have enough coverage in the event of a loss. And again, it doesn't have to be a total loss. A lot of people think, well, you have to have a total loss for it to work. No, if the windows blow out and it meets your deductible, they're going to pay you for the portion, the money that you need for the code upgrade. Go ahead. Okay. What questions were on?
Also, Teresa had a question. If she says, if name of storms, do we need to list all the storm names?
No. That's a good question. No, you do not need to list the storm names. Basically, if you purchase named storm insurance, if a storm hits your association and it has a name like Tropical Storm Irene, Superstorm Sandy, Hurricane Ida, then your percentage deductible is going to apply. If you only have the hurricane deductible and a tropical storm hits you that has a name, then you would not have the percentage deductible. You would have what's in the middle of this presentation called the AOP deductible or the all other wind deductible.
Okay, after Victor's question, let's continue so we can get through all the material.
Go for it.
Victor's question, does the percentage apply to the master only or HO3 or HO6 policies?
It applies to the exact line of coverage that was damaged. So again, in this example, the building is worth $11 million. So the deductible would only apply to the $11 million. If only the pool got damaged, then your deductible would be 3% of $46,000. So it's a percentage of whatever is damaged, not the total, and has nothing to do with the unit owner policies. Okay.
Okay.
All right. So let's move on, because that's already on the property. So we'll go to the next thing, which is the equipment breakdown. The equipment breakdown, just quickly, is giving the association coverage for any electrical or mechanical damages that happen to your building. A lot of associations say, well, I don't have any equipment, we don't need to insure it. That's not really how it works. An example is if lightning strikes down the road and hits a transformer and causes an electrical surge through your building and burns out the wires of the meters or air conditioning units or irrigation systems, this is the policy that we would be filing a claim under, underneath the equipment breakdown policy. And in this policy, and in this example, your deductible would only be $1,000. It's very important that you have this policy, because in South Florida, there's lots and lots of electrical surges that happen. And a lot of board members don't even know why they have this policy, so they forget to use it. And it's a very, very important policy to have. Okay. Then we're going to go on to the general liability. So the general liability basically is giving the association coverage for $1 million of coverage for any bodily injury or property damage that happens to the association, or why the association gets sued. So what happens mostly in associations is someone sues and says that they slipped and fell on the property, or somehow the association damaged someone's property. So what ends up happening is if we get sued, we need an attorney. So in this example, Philadelphia Insurance Company would come in and they would give us an attorney to defend the association, and would defend up to $1 million of coverage. And general or aggregate means for the policy period, which is $2 million. So you have $1 million per occurrence, $2 million for the year. Products and completed operations doesn't really apply for a condo or an HOA. It's just part of the way the form is written. Medical expenses, that's if somebody gets hurt on the premises and it's obvious that it was our fault, and we don't want them to sue us. We would file a claim underneath medical expenses, and the carrier would pay up to $5,000. And then hired and non-owned auto is when the association is using their own vehicle on behalf of the association. And if let's say you're driving to Home Depot and you damage someone's property or hurt somebody, and the association was to get pulled into the lawsuit, this is the policy that comes and gives the association $1 million of coverage to defend ourselves. Okay. Now the premiums are determined by a lot of things, but the number one thing that's causing rates to increase for liability is fraud. I don't know if everyone knows this, but the Tri-County, Miami-Dade, Broward, and Palm Beach are the 3 most litigious counties in the country, and they're back to back to back. So what's ending up happening is that because of all this fraud, insurance companies are leaving the state of Florida. I think probably between 15 and 18 carriers have left the state of Florida in the last 7 months. Either they've gone out of business or they've just left entirely because they don't want to write in South Florida. And as a result, that's one of the reasons why rates are going to go up. I'm going to go over the other reasons later. But when you have a lot of fraud, specifically with liability and with property, that's one of the main reasons why rates go up. So we have to try to limit our exposure with regard to fraud. And basically, we need to show the insurance companies why our association is a good risk to insure, which I'm going to go over later. Hopefully there's no questions on liability. If there are, you guys can chime in. Next is the directors and officers policy. Directors and officers is basically giving the association board members coverage so that if you get sued by the unit owners because of the decisions that you make as a board member, this is the policy that covers you. This covers the property manager, this covers the board members, and it covers all of the committee members. So no one would be on the board if there wasn't a directors and officers policy. You want to make sure that your defense costs are outside the limit of liability, which means that you basically have unlimited defense costs. And of course, you want to make sure that your property manager is covered. And in almost every circumstance there is. A lot of board members don't realize that committee members are covered as well. So if you have any type of committees, those people are also covered. Now, not everything is covered, but I'm going to go over a strategy on how to get defense covered.
And Brandon, you know, this especially for the board members and for the property managers is so important to have the adequate coverage or even a little excess coverage, because these are all volunteers. And you make a decision, a lot of times, you know, you're not a professional going ahead and making a decision on a professional level. And everybody's litigious these days in light of the Champlain Towers, unfortunately. To me, and again, you're really the expert, but, you know, I always tell the client, go for a higher limit. It's not that expensive to start with. Okay, and it's protecting the people that are serving the community.
Yeah, I mean, it's a really great point. And what we're gonna, when we get to the umbrella portion of the policies, that's really where an association goes to get their extra coverage, because you never want to purchase, like for instance, the directors and officers, you never want to purchase a limit more than what your umbrella is going to cover over. I see a lot of times where insurance agents are selling associations, directors and officers policies with a $2 million limit. I'm always against that, because the underlying insurance is the most expensive. So you always want to buy the limit of insurance at the least limit where the umbrella can cover over, which is $1 million. So when we get to umbrella, I'll show you how the umbrella works, so you can get tens and 20 million, $30 million of coverage without having to pay extra for your directors and officers. But most definitely, that's an important part of the puzzle. Okay. When we go to crime insurance, this is also really important. This is a state statute. You have to buy this coverage. This is a bond. A bond is guaranteed funds. And in the state statute for condos, you have to buy a bond, and the bond limit must represent the maximum amount of money that you have in the operating and reserve accounts combined at any one time. So a lot of I see this a lot where associations totally have the wrong limit, and it's a big exposure, because if somehow unit owners, board members or employees or property managers were to steal money, it's the next slide, Jeff. Were to steal money, there has to be a guaranteed way to get that money back to the unit owners. So in this example, we're using a $150,000 limit for employee dishonesty, forgery, and alterations. And you can read all of them, they're all right there. But the question needs to be asked every year: what is in your operating account? What is the maximum you're going to have in a reserve account? And then you have to add those two numbers together, and that is the limit that you have to purchase. Okay. Next is the cyber policy. Now, cyber is a policy that covers the association for in the event, you know, your individual computers get hacked into, if you're using them as a board member, or if your property manager's computers get hacked into, and personal information is being stolen, or unit owner information is being stolen out of those computers. Most of the time, associations purchase this if they have over 150 units, because they're required to have a website. But I've had a personal example where one of my property managers, their emails got hacked into, and the hacker got into her email and created a new email address. It actually was an email address that said my email address, blevy@legacyinsuranceassociates.com. And they spelled associates incorrectly, and then made it look like I was sending an email to the property manager asking her to wire or transfer me the insurance renewal numbers. And she called me and she's like, Brandon, why are you telling me to transfer the money. I've already paid this. And I'm like, I have no idea what you're talking about. And we found out that someone had hacked into her computer and was sending emails trying to get people to send, trying to get her to send money to us. So thank God we had the cyber coverage, and that covered any expenses that we had with relate to that. But it definitely can happen. Is it a huge exposure? I wouldn't say it's a huge exposure, but this policy is very inexpensive. It's like only $436 for the year. So it's something that you got to consider because, because it can happen, and it can be very expensive if something bad happens.
I will tell you, Brandon, from all the clients that I have, I would say that we have cyber type of crime that we see probably 6 to 10 times a year.
Mm-hmm.
So and it's getting worse.
Yeah, it's definitely getting worse. That's part of why the premiums are going up for cyber. There's just so much more information on the internet, and I know these hackers know that associations are not as savvy as they should be in protecting that information. So that's why this policy, I think, is worth having, because it's relatively inexpensive for the potential risk that could happen. So, but I understand people are trying to cut premiums because premiums are going through the roof. But it's just something that I just want to make sure everyone understands on how it works and why you do it.
Also, Brandon, before you go on to the next slide, I just want to mention to those people that are going ahead and writing in questions, we're getting so many. I want to get through your presentation. And, if I see something that's very spot on, right onto your issue at the moment, I'll interrupt, but otherwise we'll take all those questions at the end. So you can get through the
Yeah. I mean,
presentation.
if it is pertinent to the thing,
Right.
let's hear it for sure. But I understand. Okay.
All
So
right.
now the umbrella policy, basically what we were just talking about, the umbrella policy, if you think of it literally like an umbrella, right? It covers over and protects the association for additional limits of liability over and above your underlying insurance. So in this slide, you can see where it says underlying insurance. I've already talked to you about hired and non-owned auto, general liability, directors and officers. I'm about to talk to you about workers' comp. But if you have a claim at the association for over $1 million, $1 million in today's day and age is nothing. I mean, that goes like this. So you have to have an umbrella policy. So in this situation, and in this example, it's a $25 million umbrella. Now, the standard used to be about $15 million, where every association really should have 15. I tend to see on high rises, the standard is closer to 25 million. But these premiums are going up because there's a lot of claims that happen. But I can tell you it's an extremely, extremely important policy, because God forbid someone drowns in the pool, someone gets shot, someone gets raped, the board does something really stupid, and you get sued for more than $1 million. The umbrella is really crucial. Champlain Towers has definitely affected the amount of insurance carriers that we even want to write umbrellas in South Florida. I'd say there's probably only 3 or 4 carriers that are even willing to write in South Florida right now. Some are non-renewing, some are jacking up the rates. So it's very important that your agent shops this properly. And I'm going to give you some examples soon of really what you need to do to make sure you get the best possible rates. So that's umbrella. Next, Jeff. Okay, now this is a really important policy that I know that some associations, are tending to say, well, listen, we have to drop something to lower our rates. And I know that some are trying to drop the legal defense policy. I would strongly recommend against that. Let me make sure you understand how it works. Legal defense policy basically is coverage that gives you full legal defense or unlimited defense, basically, for claims that get denied by the insurance company. Okay, so let's say we had a claim. Let's say we had an issue where there's mold in a unit, and we file a claim underneath the liability policy, which is bodily injury caused by the association. We file a claim underneath the liability carrier, and your liability carrier has an exclusion on the policy, says that we don't cover anything related to bodily injury due to mold. Okay, so now you're still getting sued. So when you're getting sued, now you have to go hire an attorney, pay them $400 or $500 an hour to defend yourself. This policy, when you get denied by the insurance company, that's when this policy is triggered, and this policy then comes in and defends you. Now, it doesn't pay out any of the settlement, but they come in and they give you an attorney to continue to defend yourself, which is invaluable. Let's say the board members get, let's say the board members don't allow someone to rent a unit for whatever reason, and that unit owner comes back. That renter comes back and says, "Well, listen, you didn't let me rent because I'm gay," and it's some type of discrimination, and now we get sued. So what ends up happening? We file a claim underneath the directors and officers that could get denied for discrimination if it's not covered underneath the D&O. So now we're still being sued. This policy gets triggered, and they come in and defend the lawsuit. So it's really, really important, because if you have this policy in conjunction with your other liability policies, 99% of the time you're going to have an attorney to defend you. And attorneys are the ones that cause most of these bills to go up, which is what I'm going to go into and why rates are going up so much. But that's how the legal defense works. Yeah.
And Brandon, isn't it true, because I know that I've had it in some clients of mine, that they were able to request actually their own attorney, who might be a litigator, who they're comfortable with, as long as their attorney negotiates the rates with the insurance company, they may be able to use their own attorney.
That cannot happen underneath the legal defense policy, but that can happen with some general liability policies, and some directors and officers policies. The majority of them don't want that, but there are endorsements that you can get with some liability carriers that give the association the choice to choose their own attorney. But it's not everyone. But if you can get that, obviously that's a huge benefit. But that's a good question. Let me see what else is after that. Quickly, the glass policy is a policy that covers the association if you have a lot of glass. Obviously we just said, if you have a hurricane and you have even a 3% deductible, in that example I gave you, is a $330,000 deductible. It's a high deductible. And if you, God forbid, if you had a hurricane or a tornado come in and blow out the windows, it may not hit your deductible. So if you buy a glass policy, the glass policy comes in and they pay for all of your glass up to $350,000 with a zero deductible. So it's basically a gap policy that gives you coverage to make sure that at least your glass is going to be replaced in the event of a storm if you don't meet your deductible. A lot of buildings forget to buy this, and it's really not that expensive.
And Brandon, would that bring up the to code, or would that just be replacement?
There's different options inside the glass policy. Some you can get it just the old glass that you have. Some you can get the replacement glass, and some they give you the code upgrade. Obviously, the code upgrade is going to be way more expensive than if you just put in the other glass, but there's different options inside of that carrier, and there's only one carrier to do that, which is US plate glass. Okay, and then the workers' comp. The workers' comp, everyone asks me, well, we don't have any employees. Why do we need a workers' comp policy? This is a waste of money. We don't need it. And I know everyone asks that, but that's not actually the truth. In condos and HOAs, workers' comp is very important because it covers two things. First, it covers volunteers who work on behalf of the association on a voluntary basis. So let's say you have a board, a board meeting, and one of the unit owners says, hey, listen, I got nothing to do today. I'm going to do some landscaping, or I'm going to do some painting, or I'm going to go to Home Depot, or I'm going to go to the account and pick up something, whatever it is. And the board says, okay, go ahead and do that for us. And now that person gets hurt while working as a volunteer on behalf of the association. The policy will cover 100% of that person's medical bills if they get hurt while working on behalf of the association. And then secondarily, but probably more importantly, is it covers uninsured contractors. So you're required to, well, you should basically, anytime you hire a contractor, you collect proof of workers' comp, proof of liability, and making sure that they're licensed. But and even if you do that, contractors lie sometimes. So they either they give you a fake certificate of insurance, or they don't pay their bill and the insurance is not in place. They hire an illegal person or a day laborer. Now, if that person is working on at your premises and they get hurt, they're going to come back and sue you. So the workers' comp policy covers 100% of their medical bills and 66 2/3 of the average weekly wage, so that we can't be sued. So that's why it's important. I know all of these things add up. That's only $616 for the year, but there's a lot of exposures that you have. And if you don't understand why you need these policies, you just think that they're a total waste of money. So hopefully, I'm not getting much feedback, but hopefully this information is showing you why these policies are important.
Something, Brandon, and also what I always tell the client, you have to be price sensitive, but you also have to have a fiduciary responsibility to the association, because ultimately those costs are going to be passed on to the unit owners.
Of course.
When you spread out the extra cost over 100, 200, 300, 500 unit owners, a lot of times we're only talking about, a few cents or a few dollars per month per unit owner to have adequate coverage.
Yeah, and I wish that the board members at the Surfside incident would have thought that way, because that was a tragedy that happened, and it's going to lead into the reasons why insurances is going up. But yeah, you have to think like this is a business, and when you're running a business, you have to make tough decisions and potentially increase maintenance to cover things that are major exposures. So, and flood is one of them. Flood insurance. There's a whole bunch of new changes in the flood market right now. All of flood insurance just changed effective 10/1, something called Risk 2.0. So everyone's policy is going to change moving forward. The flood insurance covers the foundation of the building and the building in the event of, obviously, of a flood, of rising water. And, prior to just 10/1, everyone used elevation certificates and flood zone determinations and all this other stuff. Now the government has changed the way that they're going to quote flood insurance. And you're going to basically just need to know your address. Although elevation certificate may help, but rates are going to change. I would say 30% of the policies are going to go up, 20% of the policies are going to go down, and 50 are going to stay about the same. So hopefully your agent knows what they're doing with respect to flood insurance, because if rates do go up, there are alternatives potentially to get your rates down, like private flood insurance carriers, where they come in, you don't write it through the government, and you potentially save money. So those are different things that you have to look at when you're looking at your flood insurance. Okay. We can skip through that. You can skip past that. EOI Direct, that's just a way that you get proof of insurance online. Okay, so before I move on, I know that was like 30 minutes of coverage. Is there any specific questions that anyone has about the coverages that you want me to go over? And is this too boring, or is this too much detail? Does anyone have any feedback on any of that?
Well, something, Brandon, we have a lot of questions, so it's not boring. And again, it's such a large, important topic for any association that I think sometimes we have to go into some detail. So when you're ready, we'll start answering some of the questions that's been answered. Let me
go over this next slide so I can just explain to everybody the main reasons why rates are going up so much, and then we'll flip back to the questions. Okay. So now, this is what I know is happening in the market. Every insurance agent is being asked by their manager and by their board, what do I put in the budget? What do I do? What's happening? Why are rates going up? And I know for a fact, a lot of agents, all they do is say, hey, listen, rates are going up. I'm sorry, we can't do anything about it. I read an email from another agent that was sent out yesterday that's saying rates are going up 80%. Sorry, there's nothing we can do about it. That's not true. There is things that we can proactively do about it to potentially keep rates a little bit lower. But I want to make sure everyone understands why rates are going up, because if you don't understand why, it'll never change. So I already kind of talked to you about fraud, right? So fraud, like I said, in the Tri-County is a total nightmare. And insurance companies, I know this is really weird to even hear, but insurance companies are losing money in South Florida, as opposed to everywhere else in the state. So what the insurance companies say to themselves, they're saying, why am I going to continue to insure in South Florida when I can insure everywhere else and make money? So the insurance companies leave the market. Okay, so they leave and they say, we're out of here. Like I said, like 17 carriers have left. So when that happens, then it shrinks the amount of insurance companies that are available to even insure. And on the property side, there's like 4 or 5. Liability, same thing. So that's the first factor. Fraud causing insurance rates to go up because there's not that many insurance companies. The second factor is reinsurance. I don't know if you know what reinsurance is, but reinsurance is insurance for insurance companies. Insurance companies buy their own insurance every year in January and in July. What reinsurance rates are based on global events, fires, hurricanes, tornadoes, earthquakes, COVID, everything like that. So when reinsurance rates go up, they have to charge insurance companies more money. So what that does is 2 things. Either that trickles down to you, or the insurance companies buy less capacity. Capacity is just basically the amount of insurance that they can sell. So instead of an insurance company buying $500 million worth of risk to sell, they buy 300,000. So when they buy less capacity, that means they need to sell that capacity to the best risk. So when there's less capacity and more demand, obviously rates go up, right? So you take fraud, then reinsurance rates going up, then now not enough capacity in the marketplace. That's the third reason why. Then on top of that, you throw in something that's never happened before, the Surfside building going down. When that building went down, it totally screwed up the entire market. Now, no one, like everyone's afraid to write high rises. Every insurance company wants proof of all the maintenance that's being done. You know, when's the roof blast done? When was the 40-year inspection done? All of this stuff, you need to now prove it, which makes it very, very difficult to get insurance companies to want to write things. Then on top of that, they look at your claims history, your specific claims history. And if you have bad claims, it's even worse. So when you take fraud and reinsurance and capacity and Surfside and claims, it's a total freaking nightmare. Honestly, it's bad. So that's the reason why rates are going up. It's not rates are going up because they're going up. Rates are going up because there's a whole, it's just a cluster out there. So that being said, you kind of need to have an insurance agent that has a plan. If you don't have a plan on how to sell your risk to an underwriter, you're screwed. You're totally screwed. And most agents don't have a plan. They just say, I'm going to get it, I'm going to market it, but they don't really do anything. You know, and I'm telling you, without a plan, you're dead in the water. So go to the next page for a second, Jeff. So this is kind of what you need to do. And this is what I think I do really well and our agency does really well. You know, the job of the insurance agent is to paint a picture to the underwriter on why your risk is a good risk to insure compared to the building next door to you, right? The job of the insurance agent is to convince a person that's sitting at a desk that you're a good risk to sell to an insurance company at a good rate. And if you don't do that, then you're not giving the broker any ammunition to convince the insurance company not to jack you up 50, 60, 70%. So what do you need to do? This is what I do. I mean, you have to clearly outline what the association is proactively doing so that the insurance company feels that you care about them not having a claim. I know that sounds ridiculous that you have to worry about how people feel, but in reality, that's what you have to do. You have to make the carrier feel that you care about them. and that's how you potentially can get lower rates. So what does that mean? You have to show the insurance companies what you're doing. So this is what I do with my clients. First thing that we do, We talk about what is the association doing with respect to the roof. Has the roof been, when was the roof last replaced? What maintenance program do you do with the roof? Do you have an annual maintenance check? What are you doing with the plumbing? Are you replacing the cast iron pipes? What are you doing with your electric? Are you making unit owners change out their electrical boxes? Are you making sure that you don't have Federal Pacific breakers? These are the breakers that don't shut off. What are you doing the 40-year inspection? Are you doing concrete restoration? Are you doing things? On the next page, hold on one second. Wait. Go back up for a second. One of the main things that I like to do is I like to teach the unit owners and the boards strategies that they can do to change the culture at your building. So where it says unit owner and building maintenance checklist, now go to that next page, Jeff. This is what I do with my clients. We put these specific checklists together, and I come and teach this individually to the buildings on how to implement unit owner and building strategies to change how the building is being seen. So for instance, go to the next page, Jeff, for a second, because I want to show the unit owner part first. The next one. So for instance, if I come in there and I say, okay, we're going to do an educational seminar, we're going to teach the unit owners about what they need to do. And the board says, okay, we're going to pass out these checklists and every unit owner has to do them. Let me show you what's on these things. Are all water supply lines replaced with steel braided hoses? This is what insurance companies want to hear. Is the water heater under 10 years old? Because the majority of water heaters explode after 10 years, which cause water damage. Is there a drip pan with a sensor underneath the water heater? Are the ACs being repaired or replaced, or when have they been? Do you have float switches that will shut water issues off? I don't have to read every single one, but the point of the matter is you need to use these things with the unit owners so that then you can tell your insurance agent, hey, listen, we have a risk management program in place for not only the unit owners, now go back up to Jeff, but also for the buildings, where we care about the age of the roof and when the last mitigation report was done. And we care about the fire extinguishers being updated and the smoke detectors. All of this stuff matters. And if you don't tell the insurance companies that you have this proactive approach to risk management, and you're going to end up getting a higher rate increase than if you didn't. Think about it. If you were an underwriter and you had to make a decision on what to charge somebody, and one agent gives you a whole bunch of things that the association is doing proactively and another does nothing, who's more likely to get a better price? I mean, it's obvious. It's the first one. So if your agent is not doing these things for you, or you don't have this type of plan in place, I would strongly recommend that you get it put into place either with them or with us, because that's going to differentiate yourself between the building next to you. And that it really does make a difference. I know some agents will say it doesn't make a difference, it's all baloney, they don't care. It's not true. Any additional information that you can give the underwriter does benefit you. Okay.
Brendan, it was also, we've done it and it's pretty unique to you as far as going ahead and rather than having a 1-year premium, sometimes going ahead and extending it to locking in on a longer term of the insurance premiums.
Yeah, for sure. We did that a lot a few years ago, where we went ahead and put policies in place for, instead of 12 months, we negotiated an 18-month policy or a 2-year policy. It is possible to get in some instances now. It's not as easy as it used to be, but it's definitely something that you have to consider and that you have to look at every year. I mean, honestly, in the beginning of this year, I proactively canceled some of my association's policies in February when they were renewing in May, June, and July, because I anticipated what was going to happen, that the rates were going to go up thank God I did that, because from February to now, rates have gone up like 25%. So they would have been paying a lot more money currently if we didn't make that move. So, you know, it all comes down to like, it's not rocket science. It all comes down to having a plan. You have to have a plan, and you have to have a strategy on how to manipulate the system, because at the end of the day, everybody, this is all a big game behind the scenes. It's a game. And if you don't have the right people on your team playing the game, you're going to get crushed. And that's just a reality. Let's open it up to a few questions, and then I'm going to get into the HO6 policies and the certificates, because it looks like we have like a lot of questions now.
Yes. There was a question on D&O, and I've never really heard this term, but what does Bell endorsement mean? Have you ever heard
Well,
that?
Bell endorsement is an endorsement that one specific carrier provides. It's called Philadelphia Insurance Company, that they called their endorsement a Bell endorsement. It's additional coverages that the insurance carrier provides underneath their specific policy. So in order for me to like go into in detail, I'd have to have the Bell endorsement in front of me to reference it. So that person can call me and we can go over it directly. But it's basically that specific insurance company's additional sublimits of coverage that they provide.
Okay, another question was D&O, does D&O coverage go back 5 years?
D&O coverage, it needs to go back to the inception date of the association. You need to make sure that you have something called full prior acts coverage underneath your policy, which basically means that in the event there's a claim, that it's going to cover you all the way back from when the association started. When you change in directors and officers carriers from 1 year to the next, there's something called the prior litigation date that changes, which basically says that the insurance company is going to cover you from the date the policy started moving forward into time. They should cover you from the date the policy started moving back into time, but they will not cover you for anything that you know about or knew about prior to that date. So it's very important, very, very important that you have full prior acts coverage.
All righty. Then there was a question with the crime policy. Does a fraud issue apply under crime?
Does a fraud issue apply under crime? I'm not sure if I understand what they're saying by that.
Well, maybe Jacqueline can go ahead and retype it, and it'll be a little more specific. We'll give you a call.
And most of the people that are stealing from the association are doing, if unit owners are being fraudulent, I mean, potentially that is covered. The point, this is for employee dishonesty. So if board members are stealing money and they end up getting prosecuted, that's how you get your money back. That's the point of the policy.
Right. Also, now we have a question from Tracy. Would the cyber policy cover office folks using sham websites to convert PDF files, which are in place to capture the data or the association residence information? I guess really what they're saying is if somebody takes something off of the website and they alter it.
I mean, the main objective of the cyber policy is basically if the computers get hacked into and by hackers and information is stolen, then there's depending upon how comprehensive the policy is, basically determines, your coverage. So some are more comprehensive, some are less comprehensive. Obviously you want social engineering and things like that, but so I can't answer that specifically, but she can call me and I can try to get through it with her.
Alrighty. Another question is, so if we get denied, then the legal defense coverage kicks in. If the other party wins, where do we get the money from to pay the claim?
Well, that's a really good question. So the legal defense policy only pays for the defense, the attorney. So quickly, as an example, you get sued for $50,000. We file a claim. The carrier denies the claim. Okay. So now you have no defense. You have nothing. Now you go and file a claim with the legal defense, and the legal defense comes in and it's $25,000 worth of attorney's fees, and then you settle for $40,000, the $25,000 gets paid by the legal defense, and the $40,000 gets paid by the association. So legal defense does not pay any settlement, but they pay all of the defense.
Right.
If you didn't have it, you'd be paying the defense and the settlement.
Okay, then we have a question, and I know that you covered
Wait,
it, but.
Mark, let me interject for a second. We have one person with a hand up for quite a while. Let me
Alrighty.
enable Bernard's mic. Bernard, please go ahead and unmute yourself and ask your question. Thanks for holding on. Bernard, go ahead, please. Unmute yourself. Going once. Going twice.
Nice, it's Evan. How are you? Pretty
All right.
good. Can't wait for Friday.
All right, we're good. Mark, go ahead to the next question.
Okay, call me
Alrighty.
Thursday. We're gonna cut that check for the repair.
All
I
right,
think
think
someone is talking
some-
right
yeah.
now. I think Joey may be talking. Or
I've got him muted. Go ahead, guys.
All righty. Then we had a question basically, which comes up again, as far as if a contractor, and a lot of times, clients ask me this, every time. The contractor has a workman's comp exemption.
yes.
Does their association workman's comp cover that?
Well, the workers' comp exemption is basically giving the association the paperwork saying that the employee is exempting themselves from comp, so that they're not required to purchase it, and you're accepting that as okay. Now, obviously, if something was to happen and they were to try to sue you, you would be able to prove that he exempted himself from workers' comp because you have that coverage. Now, if it got further down the road, we would of course file a claim underneath our, if any, workers' comp to see if that coverage would be needed. So the answer is yes, we would be filing the claim. But the point of the exemption is for us, the association, to have proof that they chose not to purchase their comp, but they know that they need it.
Okay.
Now,
We have
let's move on. We have about 10 minutes left on the
Yeah, I
average
think we should
time.
move on, and then we can
And-
get to the questions.
And also, we'll answer all the questions afterwards. And if anybody, we don't want you to leave, but if anybody has to leave, this will be on the CARD website within a few days as well with all the questions answered. So Brandon, back to you.
Okay, so if you can just quickly, put back on the, put it back on. Okay, good. Here we go. So now what I want to talk about, and this is super important, is what an HO6 policy is, what an HO3 policy is, and how they work in conjunction with each other. Okay, so so first off, I want you to go to the next slide. So what I'm about to read to you right now is this is strictly for condos now. What the association's master policy is insuring for and must insure for. Okay, this is what for condos, what we have to insure for, the association. This is directly out of the statute. Condominium association responsibility for the statute. All portions of the condominium property as originally installed or replacement of like kind and quality in accordance with the original plans and specifications. This is exactly what the association has to insure for. Now, when we go to the next page, and then I'm going to really give it to you in an easy way to understand. Then when you go to the next page, this is what the association is not insuring, which is what the unit owner has to insure for, which is what the HO6 policy is for. So what I'm about to read is what the the association does not insure. The coverage must exclude all personal property within the unit or limited common elements, floor, wall, ceiling coverings, electrical fixtures, appliances, water heaters, water filters, built-in cabinets and countertops, window treatments, including curtains, drapes, blinds, hardware, and similar window treatment components, or replacement of any of the foregoing, which are located within the boundaries of the unit and serve any one unit. That's the unit owner's responsibility. So a very simple way to remember this, this is again only for condos. However the building was originally built, per the original specs, minus anything that I just read, the association has to insure. And everything that's on this little page is what the unit owner is responsible for. So I know no one's going to answer this, but I'm going to just say it. Based off of that, would air conditioning units be the responsibility of the unit owner or the association to insure? Does anyone know? Does anyone want to guess? Put yes or no? Is the association responsible for the ACs? Yes or no? Any answers in there?
I have a few people saying unit owner, unit owner, unit owner. 3 people say unit owner.
And that is wrong. The unit owner is not responsible for the ACs. The association is responsible to insure all of the air conditioning units in the condominium association. The reason being, if you go back to the slide before, all portions of the condominium property as originally installed or replacement of like, kind, and quality in accordance with the original plans. So you have to ask yourself the question, when your building was built, did it have an air conditioning unit? If the answer is yes, then the association has to insure it. Because if you go to the other page, air conditioning units are not something that is excluded underneath the master policy. So air conditioning units are the responsibility of the association to insure, not maintain, but to insure. And a lot of board members and a lot of property managers don't realize. So that answers, if you go back now to where how does an HO6 policy work, go up one. So that kind of answers what an HO6 policy and what an HO6 policy is. An HO6 policy is a condo unit owner policy, and an HO3 policy is a homeowner's policy. The HO3 covers a single family home, or if you're a homeowners association, you need to read your documents to see whether or not you need an HO6 or an HO3 policy. That's very, very important. I've gone through a lot. I'm sure a lot of HOAs that they think because we're insuring the buildings with a master policy that an HO6 policy is needed. In a lot of cases, it isn't.
Brandon, would a cooperative fall under condominium?
No, co-op, you have to really read your documents to see who's responsible for what.
Okay.
So it potentially could come into effect that you need an HO3. You would hope that it would be more like an HO6. So you have to read the documents on that.
Okay.
The easiest ones by far is condo. It's super crystal clear. I just read it to you. HO3, you have to read the documents. Same thing with co-ops. And I'm telling you, a lot of agents don't even look at that stuff. So they have no idea how to advise whether or not the unit owner needs an HO3 or an HO6. What are some of the main things the policies cover? I just went over that. Are unit owners obligated to purchase an HO6? The answer is no. Even if your documents say you have to buy an HO6 policy, there's no way to enforce that rule. I think it was 2009, the statute changed and they forced everyone to try to buy an HO6 policy, but then they changed the statute because you can't enforce it. There's no insurable interest. So it is strongly, strongly, strongly recommended that everyone buys it. And again, it comes back to educating the unit owners on why it's important. The main reason why I think it's important is the last dot, which is the loss assessment limit. Loss assessment is a coverage underneath your HO6 policy that basically says that if there is a loss at the property and the association has to assess the unit owner for that loss, the loss assessment coverage underneath your HO6 policy will pay for that assessment. So if you get assessed for, let's say there's a hurricane and you get assessed for $5,000 because of the damage, if you have an HO6 policy and you have a loss assessment limit of $5,000, you can file a claim underneath your policy and the unit owners will pay their assessment that way. And if more unit owners have that coverage, then there is more ways to transfer the risk away from the association. Therefore, more associations can buy a higher deductible, which will lower their premium because there's a way to pay that higher, well, you can't say deductible, but pay that higher deductible through their loss assessment. So those are different strategies that you need to know about when making a determination if you want to buy a 3% deductible or 5% deductible. The more people that have loss assessment, the more risk that you can transfer, and then it's a little safer to buy a higher deductible.
Something, Brandon, I know that back in 2005, when we had the major storm that came through in my association, we had
Right.
major landscaping damage, which is not covered by the association's policy. They assessed, though, all the unit owners for all that cleanup. And because I had, the
Loss assessment.
the loss assessment policy, I didn't have to come out with any money.
Yeah, I mean, it's extremely important that you have that coverage when you're in a condo. I mean, the loss from that very example, you could have a claim that doesn't hit your deductible, and you still have to pay an assessment of $5,000 or higher. I mean, do you really want to come out of pocket $5,000 when you're already getting your maintenance increase because of insurance and you're getting special assessments? So if you buy an individual policy, and as a board, we keep educating the unit owners on why they need it and how it works and how it protects them, it's just overall better for everybody involved. The problem is no agents want to take the time to do these type of presentations because it takes so much time and effort. But I'm telling you, when you do it over and over and over again, it's just overall better for everybody.
Also, Brandon,
So-
right now,
yeah.
we're at our scheduled
Yeah,
time that
I know.
we advertised. But so those people that need to leave because they've scheduled, for an hour and 15 minutes, all this information will be on card. Also, you can call Brandon Levy directly at Legacy Insurance. He's always willing to talk. As you know, he likes to
Yeah,
talk.
of course. I only really need 5 more minutes, less
Okay.
than 5 minutes, to
Right.
just
and
go
then-
over quickly certificate. Go ahead.
Right, and then in addition, after those 5 minutes, obviously we'll stay on to answer, some more questions, and also the group for CARG is available. So, those people
Okay,
that
just
have to
very,
leave, we
very,
do
very
understand.
quickly.
Go ahead, Brenda.
Very, very, very quickly, just to go to the second to last slide. I just want to make sure everyone who's still listening understands how to read a certificate of insurance. Go to the next slide. So basically, this is a sample certificate of insurance, everybody. And the most important thing on this certificate with respect to liability for an association is number 12. Number 12 is the box where you need to make sure that your association is listed as an additional insured underneath the contractor's insurance. The reason being, if you hire a roofing contractor or electrician or whatever, and they come in and they damage the association's property or hurt somebody, and then we get pulled into the lawsuit, we need to make sure that their insurance policy is going to cover our association so that we do not need to file a claim underneath our insurance, which causes our insurance rates to go up. So when you get a certificate of insurance, you need to make sure that your association is listed, named as an additional insured, and all these other numbers, 1, 2, 3, 4, 5, that I was going to go over, but we're running out of time. That is all of the information that you need in order to contact the insurance company directly on your own from the contractor's insurance directly, so that you can file a claim underneath the insurance of the contractor to help pay for claims that we're getting pulled into. And if anyone needs more information about that, of course, call me. But with my clients, I basically not make them, but strongly recommend that when they're hiring contractors, that they send us the certificates so that we can make sure that they're being done properly, so that we don't get that insurance rates don't go up for things that we have ways to transfer risk away from. Anyway, I went really fast for that, but that's it. So let's open it up to, I don't know if there's any more people still left on here, but if there are, you guys want to ask more
Yes,
questions?
there's a whole bunch of people that, almost everybody has stayed on.
Okay, so
Here's a
you want to
question.
open it up?
Sure. First of all, Jeff, is anybody raising their hands? Because I can't see that. I can only see the Q&A. Okay,
Do as
so
many questions. Well, we have a couple of people had their hand up and they just put them back down. But we don't want you to leave. But if you must, this recording will be on the cardforhelp.org website within a couple of days. So any questions that we do answer will be on the website. And if we don't get to your question, please do not take it personally. There's a lot of them there. We're not going to get to all of them, but Brandon will be forwarded your questions on a spreadsheet, so he will see them all. And there'll be a brief survey at the end where you can type in something that you'd like to ask there as well. So the opportunities will be there. Mark, back to you.
And of course, anyone can call me, because if they need help with their insurance, they can of course help. That's what I'm here for. So go
Yeah,
ahead.
that option will be on the survey as well, Brandon. So we got you covered, my friend.
All right, cool.
All right, there's a question that always comes up as far as if they want to go ahead and seek your advice or get a second opinion, do they need to sign off to Legacy in order to request the insurance policy search?
Okay, so that's a really good question. So they're talking about an agent of record letter. So initially, in order for us to review your insurance program and do an audit of the program, so I can tell you whether or not we can do better or not, you do not need to sign an agent of record letter. However, if we get to the point where I review everything and we see things that we can do differently, or you like our approach better than your other agent, it is a requirement by not actually insurance agents. It's a requirement by the insurance companies that you do sign an agent of record letter. Without that letter, I won't be able to negotiate or talk to any insurance companies on your behalf. The insurance companies force the association and the boards to choose who they want as their representative first, and then negotiate with them. The reason being is, if they just took 3, 4, 5 different agents, potentially the quote, they don't always come in the same, but potentially they come in the same, and they don't want to do the work 5 times. So they basically make the association choose who they want as their advisor. And then the letter is signed, and then we do the work. And then of course, if you sign the letter and you're not happy, you can sign the letter back to somebody else. But ultimately, you really should be making a decision based on who you think you would work best with, who has the best ideas, who has the best experience. Like, those are the things that you should be choosing.
All right, and then there was a question, is it still true that the bank will not provide a loan to the unit if the buyer does not have an HO6 policy before closing? And I know you covered that it's not mandatory.
Yeah, no, it's not mandatory. I mean, Terry may know more about that, but I think that most banks, it seems like we get a lot of requests for certificates of insurance for unit owners. And I think that banks require HO6s, but my agency doesn't sell HO6 and HO3 policies. We only do commercial. So I don't know exactly, but I think some banks do and some banks may not.
All right, Terry, if you have some more information from a banking perspective, you can unmute and just jump in anytime. While she's doing that, what?
I am on the unit owner side. Those questions would need to go through my mortgage department, because on the commercial side, the certificate of insurance that we obtain is only a certificate of liability insurance on behalf of the association, on the association loan side.
Yeah.
All right, terrific. Let me just go through this. Aren't loss assessment riders of 2,000 required in Florida? Again, that was discussed that.
Well, every HO6 policy must provide a loss assessment limit of $2,000. That's true. But what I would strongly suggest that you do is, whoever your agent is, that you ask them to increase your loss assessment from 2,000 to 5,000 or 10,000. From my experience, it costs less than $100.
Right.
And most
Absolutely.
agents don't even do it because they're afraid to tell the client that it will cost a little bit more money. But if it costs another $50 and now you've gotten 10,000 instead of 2,000, that's a no-brainer.
Right. There was a question as far as, can we hear more about the new flood setup? I guess they're
Yeah, I mean, we
referring
can.
to
I mean,
the,
that's a big conversation. Of course, if whoever that is, ask them to email me or call me, and I can go
All
over
right.
that with them because it is a big change.
very comprehensive. I know, and that was from Jason, so I'm sure he'll give you a call on that. So that's kind of, that's basically covering all the questions that I see right
Okay.
here. Again, if I'm missing any, please go ahead and be assured that we'll get back to you, or Brandon will get back to you with those questions as we have it recorded. Brandon, you know, what we were talking about the other day, and Terry, if you can unmute, a lot of the banks right now will give a contingency line of credit. And that's a great way of saving some money on possibly increasing the deductible and still having the coverage with a contingency line of credit. So that would, maybe you can start on that, and Terry can jump in
I
from a
mean,
banking perspective.
from my perspective, I think it's absolutely crucial to have a contingency line of credit. I tell all my clients that they need to go ahead and look into that. I mean, banks, it seems like banks are trying to give this money away, and it's really smart to have it, because if there is a loss and you do need to somehow get money for your deductible, it's going to be a lot harder to get the money from the unit owners at the time of the loss in the middle of a big issue than going strictly to your line of credit. And when you have the money already, you're more likely to get contractors to work for you quicker, not at raised inflated prices, because they know you're ready to go, as opposed to the other way around where you're reacting and to the situation instead of being proactive. That's the whole thing I'm trying to get in this whole presentation. If you're not proactive about how to get your stuff done, the carriers screw you. So you have to have a plan. What do you think, Terry?
Well, I always tell them it's better to have the line of credit in place before the emergency than trying to get to the bank after the emergency, because once the emergency is over or the storm is over, you need the money. If you come earlier, the line's ready, you get the money, finished. If you try to go to a bank during that, you're going to wait months, because everybody's going to start trying to get loans.
Exactly.
You know, with that, along that same line of reasoning, even with landscaping, for argument's sake, you know, even though that's not covered by the association policy, it's crucial. And Charles, if you can unmute, but it's crucial to go ahead and to do those major and minor cuts before hurricane season and be prepared, and also have a vendor or a contractor in place. Because again, I know in my association, when we had that devastating hurricane in 2005, the roads were blocked, okay? We were able to go ahead and have our contractor immediately, almost the next day, because we had that relationship with the landscaper and the tree trimmer. We had that relationship, and they catered to us first. And we also had the line of credit that we were able to pay the contractor, because obviously contractors need to get paid and money talks. So Charles, maybe you can
also, you know, not just to
Terry.
chime in there on that, Mark, if they have a line of credit in place and they have huge trees that need to be trimmed, or trees that came down, and they don't have the money in the budget to have those removed, and that, as Charles has mentioned, is thousands of dollars. They can use their lines for that.
Right. All righty. I think Charles is locked, Jeff. I don't know if he has that. But
I'm here, but I
He's
don't have
unmuted.
am I unmuted now?
Yeah, go ahead. Go ahead, Charles.
Yes, as one of the biggest concerns with any major catastrophe storm is water. That is your biggest damage. And what happens is when you water and wind, they weaken the root structure of the trees. Big trees go down. If you have a large ficus tree or banyan trees in your community, these particular trees can cost literally thousands of dollars just to cut them up into sizable pieces that they can be loaded into a truck and removed. Then the root ball has to be addressed. Some of these root balls can be 20 feet, 30 feet across, which means that we'd have to come in with a grapple, pick it up, put it on a flatbed truck, and then haul it away. Then you got to fill the hole, you got to replace the sod. So again, thousands of additional dollars could be spent on tree clean, post-hurricane tree cleanup. So it's very expensive. So that's why having your line of credit in place, whether you need it or not, is critical.
Brendan, there's also a question as far as, and Catherine, maybe you can unmute, you know, the interplay basically between the insurance company and the public adjuster. A lot of times, you know, a client comes to me and unfortunately they sign off on a check from the insurance company. And the very question that I ask is, did you go ahead and speak to a public adjuster to assist you? There's so much, many times, there's so much extra money that can be gained through the association through a good public adjuster. And maybe you can just have an interplay between the insurance and the public adjuster. And I see that Catherine just signed on over here. So maybe Catherine, you can talk a little about that, and then Brandon, you can do a follow-up.
Yeah, well, I mean, being your public adjuster, being able to help you out always determines on how good your insurance policy is. So insurance policy is number one, because we can only fight for what you got on your insurance policy. And again, that starts with having a good policy in the first place. So what we do is we basically will take a look at the damage and we'll look to see if it's worth it for you to file a claim. If it is, we'll assist you in that process. And we make sure that we document all of the damages, do a great thorough scope, and therefore after that negotiate with the insurance company. And there's a lot of details that goes in between. But that is our process, and we are very, very successful in helping out the clients. We come in the beginning of the process when when the damage may have just happened, or we couldn't get called, you know, after they file a claim and they say, hey, like, we're not getting anywhere, or we've been lowballed and don't know what to do. So we can come in many different stages.
Yeah, terrific. And I see that Adam is here. There's also a question. Basically, is Adam still here?
Yes.
He's there. Yeah, he's
yes,
there.
he is. Okay.
He's out in space.
Yeah.
He's with William Shatner out in space there.
Right. There was a question as far as with mold remediation. You know, it's something that, again, is very litigious in a lot of associations. What preventative steps should be taken? I mean, obviously, the first one is always to have, when you have, in order to mitigate the water damage, is to have, you know, a water extraction and mediation company on hand, and have at least a relationship with them. But they were talking about as far as that and the interplay with insurance. So Adam, maybe you can do that, but you know, then Brandon, if you can speak a little about with the mold remediation problems.
Yeah, sure. Typically, when you have a water damage situation, whether it's minor or major, responding right away, getting someone to come out within 72 hours is very important. Your water damage situation, 72 hours later, that's when you can start saying it's Cat 3, Category 3 water damage, and you can also start to get mold growth. So don't let it go on too long. Respond right away. You know, you get more coverage if you have to file a claim. And, you know, I suggest if you have something small, don't file a claim right away. Try to lower your claim ratios with whatever insurance company you're working with. And, you know, you don't want an unnecessary claim filed on your history. It makes you harder to, you know, rewrite. So
and what you just said right there is exactly that's what I wish more contractors said, but that's not what most contractors say. And what causes rates to go up so much is what we said in the beginning, which is fraud, where contractors and public adjusters and attorneys, they all come together as a team, and a regular $10,000 claim for water damage ends up being $100,000. And then if you multiply that by hundreds and hundreds and hundreds of buildings, there's so much fraud in the market that everyone leaves. So it's a really good point that you just brought up, Adam. Like, the association needs to be proactive in making sure that they have the right water restoration company that they trust, and a public adjuster that they know is not going to screw them, and an attorney that knows what they're doing is not going to screw them, because there are so many contractors out there that's the main reason why I think rates are going up, because there's just so much fraud, and there's really a very difficult it's difficult to change, because most of those companies are the ones that are funding Tallahassee and the people who make the decision. You know, without any change up in Tallahassee, I don't see rates going down anytime soon. So what you just said was really crucial.
Everyone's got to protect themselves first, correct? And Catherine, being the public adjuster, and myself, you know, water damage and mold remediation, will definitely address your situation honestly, and you know, we'll put ourselves in your shoes. So
There's a
thank you.
Thanks, Adam. Brandon, there was also a question concerning roofs, and Joey, you can unmute, but basically they asked over here, are carriers refusing to insure roofs over 20 years old? And
That's a really good question.
Yeah, and I guess the
That's
second part of that, you know, it would be for Joey from Paul Baines Roofing to just to chime in as far as the life expectancy of the roof. But Brandon, why don't you start that off?
Yeah, okay, yeah, let me start with that. I mean, that's a really good question, whoever just asked that. The truth of the matter is that because, again, I keep bringing it back to fraud, but it really is the reason. Because of so much fraud that happened in the past 3 years, and where insurance companies ended up paying out on roofs that probably weren't really damaged, the insurance companies have tightened their guidelines a lot. Not every carrier, but what's coming down the pipeline that I've seen is that there's a lot of insurance companies that are basically saying that if your roof is 15 years or older, either they just won't insure you, which makes it harder to get someone to write you, or they put something on the policy called actual cash value instead of replacement cost. Replacement cost is they give you the money to replace your roof brand new. Actual cash value is they take your roof and they determine what the deteriorated or depreciated value is, and that's what they pay you. So if your roof is 25 years old, your roof is worth nothing, and you're not going to get anything. So it's really, really important that, number one, you always try to get a policy that has replacement cost. But if you can't, then you have to make a strategic decision with inside of your community on whether it makes more sense long term to replace your roof instead of just updating your roof, because a lot of associations choose just to update their roof, and a lot of insurance carriers don't consider that anything positive, and therefore they still give you the actual cash value, and that sucks. You don't want that. I don't know what you've seen, Joey, but that's what's happening on the insurance side.
I just want to be clear on one thing with going down. I mean, we all saw Surfside happen, and obviously that was a tragic event, but it was an eye opener in the industry for sure, especially in my business. The insurance companies are coming down harder than ever. The 40-year inspections are going to be harder than ever. This stuff is not going away anytime soon, and it's going to continue to progress as we get, to where they find that it needs to be. The most important thing that I would say in this whole thing with HOAs, especially I deal with them on a daily basis, is that when the insurance company is coming to your building and telling you that that roof needs to be replaced, there's a lot of companies out there that will tell you, okay, well, we can do this coating that will give you a 15-year warranty. We can give you this, that'll give you a 15-year warranty. The bottom line is that is all fine and well. But at the end of the day, if the insurance company is telling you that that roof needs to be replaced, there's no way around that. So we're going back to the fraud in the industry of insurance and contractor fraud and that kind of thing. This is another segment of fraud. I mean, the truth is these liquid rubber coatings and things that these guys are promising 15, 16, 20 years on, at the end of the day, all the insurance companies have to do is go back and look at the last time a permit was pulled on that roof, and it's going to tell them everything that they need to know.
Well,
So
that's exactly what they do. Actually, they ask
exactly.
they ask me to
Yep.
provide them with a mitigation inspection report.
Yep.
And on that report, it tells you when the roof permit was last pulled, which determines when the roof was last replaced. And if that permit date is not within, depending on the carrier, 10 years, 15 years, 20 years, then they're going to either put actual cash value or they'll put replacement costs, but they're going to charge you more money, you know, and
Sure.
it's a tough situation. Honestly, the whole thing is a total nightmare with regard to making decisions because it's super expensive to buy a new roof and it's super expensive to buy the right insurance. You know, it's tough. That's why you really just need the right people.
And no one knows the
guide you.
answer right now. I mean, that's the truth. Nobody wants to make that call right now. I mean, engineers are not putting they're not stepping their, you know, they're not stamping their name on anything right now. They want to, if it's questionable, it's gone. Bottom line.
Yeah.
You know, and the other thing is, you know, when it comes to the contractors, and this is so important, you know, clients come to me on a daily basis, they have to replace a major component, let's say a roof, okay, or an air conditioning system, you know, and especially on roofs, and especially during hurricane season, there's so many fly-by-night contractors out there. A lot of them, you know, come from out of state, they do their job, they collect the money, then they run out. You know, it's, even if it costs a few dollars more, and most times it doesn't, but it, you know, if it's a few dollars more and you're getting somebody that's been in town in South Florida for many years, and there's really only a handful of the roofers that really have been here for many years, they're here to stay. So even with warranties, you know, they'll bend over backwards, you know, to go ahead and keep you happy, because this is where their bread and butter are. If you go ahead and you get a cheap contractor and they're out of state or they're using somebody else's license, you know, when you have that problem, there's just no place to be found. You know, people like a Ball Bange, and there's many others, you know what I'm saying? I'm not trying just to promote just our people here, but you really need to go ahead and to get a well-established company that's been around and that's going to continue to be around.
Absolutely.
Any other insurance questions, or because I know it's already now 11:40. Is there still a lot of people on?
Yes, there are. I mean, listen, this is a
Okay,
crucial
so
topic. This is a crucial
this is the
topic.
chance to get.
You
This
know
is
what I'm saying?
any more questions? If anyone wants to, I'm here. I love talking about this stuff. So whatever you guys want to get some free advice from me or need me,
At this
ask me
point,
some more.
At this point, let's go to raise hands only. Preference to raising hands because there's just way too many that are not pertinent in the Q&A. So Sue, your mic has been enabled. Sue, go ahead and please ask your question. Unmute yourself.
Yeah, hi, good morning. I'm Sue Bonetta. I'm with Lakeview Management. I'm in Miami. And I'm seeing a lot, as you are seeing yourselves, with the fraud stuff. And I'm wondering if the insurance company has got anything working on being proactive about these items, including going after the attorneys that take any jackhole that walks in the door and with a limp.
Well, you know, there was a lot of talk in Tallahassee with some type of changes in the legislature that did just recently pass with respect to, you know, how many years you have to file a claim. It used to be 3 years, now it's 2 years. There's also some changes in the law with respect to how roofing contractors are allowed to market themselves to associations with respect to replacing roofs and not being able to come in there and just say, hey, listen, sign this form, I'm getting you a new roof. I don't know all the specific details on how it is, but there is a push to have change in the legislature because this issue with insurance is not sustainable long term. The rates are going up so much that unit owners are not going to be able to pay for it. And what's going to end up happening, like I said, is, you know, insurance companies are basically begging for reform. That's what's happening. They're begging, please reform the system. And it's not happening. So they're jacking up the prices. And then and they're going to keep doing it until the unit owners and the boards start complaining to Tallahassee. And then once that really starts happening, and those people in Tallahassee realize this is a huge issue, then they're going to be forced to have reform. And then as soon as that reform happens, the insurance companies are going to get exactly what they want. The rates are going to go back down. But until that happens, honestly, I don't see it happening. I know that's like not a great. That's just the truth of the matter.
There was a comment over here, Jeff. I can't see raised hands, so if we have any raised hands, please jump in. If there aren't, there was a question if we can open it up to some of the members of CARD, specifically if you have any questions on water extraction, mold remediation, public adjusting is still on, Catherine, Terry from South State for banking, myself as monthly accounting, Charles from GRC landscaping. So if there's any questions that you just want to just toss around some ideas, you want to ask a question or some comments, feel free to. We'll open that up to everybody.
Well, I do want to mention one thing when you talked about cybersecurity earlier. There are a lot of great products out there for property management solutions that are like all encompassing into one thing. But one thing I always like to preach to folks who ask me my opinions about what to do with regards to like payment portals and things of that sort, where residents' sensitive information can be on there and potentially get hacked. Always try to make it look like it's not part of your association website. So for instance, if you have Bank X or Terry, Terry's bank is providing the association payment portal for you guys, have it as a button link that goes to the bank and do not make it look like it's a part of your association website. Therefore, if anything, God forbid, happens where that information gets hacked on the bank website, it doesn't look like it's a part of the association website, and you're less likely to be dragged into any potential issues later on. So I always recommend to keep things separately.
Yeah, no, it's true. The software that we use is CINC. It's a association specific software, and people can pay obviously by credit card, e-check and all. And there is a link that basically goes to that provider, and those providers basically are almost partner banks, with the software. So
yeah,
you have a lot of extra layer of securities.
Yeah, some of them like to embed it into the association website, so it looks like you have never left the association website, and that can be very convoluted especially when attorneys get involved. So it's always best to make sure it's clearly separate, in my opinion.
Right, for sure. And let me just go over some other questions here. Here's a question for Jeff. Are you available to assist, with some of our meetings and so forth through Zoom or any other product?
Absolutely. I'm the funniest nerd that you'll ever work with. I'll keep it as interesting as possible. At least I think I am. So.
Well, we appreciate that. And let's see, here was a question really, Brandon, it's really for both of us for budgeting purposes. And obviously, right now it's morning, noon, and night doing budgets for all my clients. They're asking as far as what should we be guesstimating, and it's only a guesstimate, on the increase on insurance for budget purposes. I know that it's a tough situation. And before you go into that, just from an accounting standpoint, when we go ahead and we budget, a lot of times the budget may have been wrong the last year as a guesstimate. So all of a sudden, it looks like there may be even a more of an increase or a tremendous increase, but you really have to look at the actual premium from last year to this coming year's premium, not just the budget, amount that was put down on the budget. Because again, a lot of associations, they just throw a number out there, and then the following year, it skews everything.
Yeah, you're right. And I get it. I'm not exaggerating. I get a call every single day from, I've kind of like, not trained, but I've asked my associations to call me so that we do the budgets together, and I go line item by line item, so that very thing doesn't happen. They go off a budget instead of reality, and now they're under budget anyway. So that's that part of the process is important, that you communicate with the agent directly. But in terms of what I'm telling everybody, I mean, it depends. I mean, it depends on the type of building, but on the low end for property, I would say you should not put anything lower than a 20% increase. On a high end, I would say, 35 to 40%. There are some buildings that are written with one or two specific insurance companies that were way, way cheap last year, and they're getting crushed. Those are the ones that really need help on how to not get those huge increases. But I would say on average, you should use between 20 and 35% for property insurance, and for liability between 25 and 40%. That would be, a general statement. But if you have a plan in place to sell it, you're most likely going to be on the lower end. If you do nothing, you're going to be most likely on the higher end.
Right. Brandon, there's a question over here. How far in advance from renewal date should we start going ahead and discussing insurance?
I would say the ideal situation is 90 days prior to renewal. That would give, if you were going to change agents, that would give the new agent the most amount of time. And if you're not going to choose agents, then you should be, what I do with all my clients is that I do a pre-renewal meeting 90 days prior, so that we can discuss what's happening in the building, so that we can use that information to sell the carrier. And then between 90 and 30 days, we're communicating, getting all that information in. And then 30 days prior, we have like a quick meeting to say, hey, listen, the quotes are about to come in. And then at about 2 weeks before is when the quotes are coming in. So I'd say 90 days is ideal, but you can really do things within 30 days still.
All righty. One very quick, I can give a very quick answer. There was a question here, really, I guess, directed at myself doing monthly accounting. Can we give you a call just to toss some ideas back and forth, even though you're not our accountant? The answer is absolutely. Just like Brandon and all of us, we're always available, to talk and educate and to try to help you out on that. So feel free to give us a call. I think that's basically it. Jeff, did you have any other hands up? Because I don't see that.
There is one hand up. So we'll do this as a last one, and then I'll make sure that Brandon gets a copy of all the questions that didn't get answered that are a little too specific for this. So he'll get those in writing and get back to everybody. Marion, please unmute yourself, Marion.
Okay, thank you so much.
You're welcome.
I wanted to know, and I put this in the chat or the questions, but I know you guys have been busy, but if a claim has been made and the claim was denied and the association passes a special assessment, can owner's loss assessment be triggered then for the HO6?
If a loss has been, is it a property loss?
Yes, so a claim has been made, and I think the gentleman made mention that he had this situation where with the hurricane, they made a claim. But I'm saying if a claim has been made to the insurance company under general liability, the master, and that claim has been denied, and the association is now doing a special assessment to cover,
a loss. Well, you should call it a loss assessment first off.
So I wanted to know
Because
if the loss assessment could be triggered then.
It very well may be able to be triggered. Every HO6 policy has its own language in it, which triggers the policy to pay. So I would say the answer is yes, potentially that would be a good use. That would be a smart idea. But what I would definitely suggest that you do is that if you're going to go down that road, you do not call it a special assessment. You have to call it a loss assessment.
Loss assessment.
So you're going to write a loss assessment letter. Let's just say you're assessing everybody, I don't know, $2,000 for the loss that happened on liability. You would send it out as a loss assessment, and then have each unit owner put it through their HO6 to see if their HO6 carrier will pay or not.
Perfect. Thank you so much for your time. This was an excellent presentation. Thank you, Cart.
Thank you. I love
Yeah.
hearing that. Appreciate it.
Thanks, Marion. Thanks for hanging
All
on.
right, well, thank you,
Let's
everyone.
end on that. That was a good thing.
Yeah, for sure. I think, you know, we've gone way beyond because it was an important topic. Again, you can reach all of us, you know, through CARG. The website is CARG, the number 4, help, HELP.org. It has all of our contact information. You can reach out to any of our members. And again, it's monthly accounting, banking, cable consulting, fire, water, and mold cleanup, insurance, which obviously is Brandon, janitorial services and light maintenance, landscaping and tree service, paving, pool services, public adjusting, roofing, websites, and our newest member obviously is termite and pest control, Forever Gone. So please reach out to us. We're here to really educate and to help. We won't be doing any type of sell job. It's more for education purposes.
I appreciate everybody listening to that for an hour and a half, and I'm happy to hear that it wasn't boring and it was excellent, because you know, that's positive feedback for me. So thank you so much. And again, if anyone needs anything or wants anything from me or wants me to look at anything, just call me or email me, and I'll be more than happy to help.
All right.
Brandon, I'm gonna we'll get you all the questions that did not go answered as well this way. They're a little more specific.
Right.
Okay, sounds good.
One last thought for those people that are still remaining, there's quite a bit. If you have any topics that you would like us to go ahead and to talk about and to have this type of presentation, you know, please go ahead and sign on to CARG, CARG for help.org, and we'll go ahead and we'll sponsor a program for that. With that, I wish everybody a safe Thursday and following days. Stay safe. And Jeff, thank you again for moderating and assisting with this Zoom call. And
Hey, you could host the Oscars. You could do better than James Franco did. You know?
and again, I want to just thank all the participants for joining in, staying on, asking great questions. So anyway, be well, and we'll see you next time.